So I get to introduce our first faculty member here is Mr. Chris Prevatt. And Mr. Prevatt is the state specialized extension agent here at the Range Cattle Research and Education Center. His focus is on the economics of livestock and forages, management practices, and marketing strategies for cattle producers. He provides education on the management practices that increase the profitability of livestock and forage producers. Mr. Prevatt.
It's great to be here with you today. So we're going to talk a little bit about the market and cattle prices. I think if you look back where we were a year ago today, I mean, things have been really interesting in terms of the fluctuations and shifts that we've definitely had in this beef cattle market. Something I shared with you at our last field day 18 months ago. This is kind of what we've been focused on, is on the cattle cycle that's at play right now, and as well as the shifts and the phases of this cattle cycle. I'll just run through that with you again, and then really talk about some of those big variables, the outliers that we're really focused on here in 2018. So the first thing was that top of the cattle price cycle. We saw that from 2013 to 2015. We saw those, extremely high prices that we saw, 250 to 280 a hundredweight for some of these feeder calves here in South Florida. Then we moved into that downward price transition of the cattle cycle. So we expected to begin experiencing that as herd expansion starts taking place, somewhere between 2015 to, right now we're looking at the end of this downward price transition being somewhere between fall 2018 and 2020, and that's depending on some of our other cycles as well there. And then getting into that bottom of the cattle price cycle. That's, that's when things are going to be, they're going to be tougher on us. That's when we'll experience some of those our lowest prices that we're going to see. And then getting into that upward price transition. That's where we're focused on, getting back to that top of the cattle price cycle. And we feel like somewhere between, that 2020 low, we'll start the next bull market in terms of increasing prices. And we'll see this from a couple of different areas. One from, supplies starting to diminish from the lack of herd expansion, some contraction in the supply numbers. The new bull market would potentially come from some additional inflation that we haven't seen in the last couple of years. So when we think of those four phases of the cattle market, and again, this is a cycle. We've been seeing this for the last 150 years in terms of cattle prices. From those variables that really get us into herd expansion, if you put a price incentive out there for us, we've been able to meet it. One specific example is how much additional supply, how we've shifted feeder calves into an additional 10 to 15,000 head a week that we're slaughtering right now compared to 2017 levels. So that just shows you, if the price incentive is there in the agricultural commodities, we're willing to meet it. So getting out of just the cattle price cycle, I think another couple of the variables that are really affecting us is just the economic cycle in all. We talk about the economic cycle or the business cycle that affects our livelihoods and the commodities that we produce. And this economic cycle, it's broken down into the expansion, the boom, the growth that we've experienced since 2009. And typically these economic cycles, they'll last 5 to 10 years. Obviously, we're towards the end of our economic cycle that we're presently at. We're approaching 105 months that we're currently in our economic cycle. Now, the longest economic cycle since 1853 was 121 months. So we know that, whether it be a small recession, a larger recession, a bust, or a contraction, we know that's out there in the next, 1, 2, 3, 4 years out there. We know that's out there for us, and we have to plan accordingly for that. Now, we start talking about recessions, and people think back to, 2001, 2008, or the Great Recession, and, those weren't just recessions, but those were also economic panics. So, I think you have to put it accordingly. If you have another panic, then, you would have dramatic levels in terms of declines in commodity prices. So these economic cycles, we're focused on them because they're the downward and upward movement in our gross domestic product. So that's kind of really what's focusing on is this expansion took us to a place where we talk about that law of diminishing returns, where we've passed that point in a lot of areas in our economy, and that's where we start to have some of that contraction in terms of our economy, and start to see some of the recession-like signals here after we've hit the peak. The other cycle that I'm really focusing on right now is we look at, a ratio of stocks to commodities. And these aren't just, the livestock commodities. These are also oil, precious metals, and, the basic commodities that we produce here in the Southeast and the Midwest. If you look at our ratio of stocks to commodities, I think that what you'll see right now is that the ratio is the lowest since 1972. So you think about how, tough things were on us in the 70s and 80s in the commodity sector. We're currently at the lowest ratio. So we've seen these inflows into stocks and other investments come out of maybe the commodity or agricultural sectors. What we'll typically see as we move into a different phase of this economic cycle is moving a lot of those investments back into hard assets or real assets. So we do expect to see some additional investments in commodities, once we get out there to 2020 to 2025, really going to see a lot of that money from the stock market and other investments coming back into commodities. And that's playing into that next bull market that's out there, approaching 2020 to 2030. There's some real potential out there for some really good commodity prices. So those are some of those variables that are really affecting our cattle price cycle and the expansion and contraction of that cycle. Now, if we get to the variables that we monitor very closely in terms of the beef cattle market, if you look where steer and heifer slaughter is right now, we're much higher than where we were in terms of year-ago levels. So we mentioned, 10 to 15,000 head per week higher than where we were last year, and that's that incentive really. We saw that breakaway prices in spring 2017. Enough producers saw that need, and they shipped feeder calves to those feedlots, much earlier this year. So whenever you're producing this much more beef during this time frame, it's really going to limit those price increases that we saw this spring. And so we're going to experience about 10 to 15,000 head per week more, all the way from April to August is what our current USDA projections are. So that's really going to hold down a lot of those price increases that we saw in 2017. If we look at the last half of the year, again, we've shifted these cattle forward. We've moved them forward. So what we've seen in terms of the additional feeder calves, we're not going to see an additional increase in terms of the number of head that we're going to slaughter in the second half of 2018. It's going to be very close to where we were in 2017. So second half 2018 on the supply side, we're going to be very close to where we were in 2017. Now, we talk about, maybe not on the fat cattle side of things, but we talk about feeder calves. If we look back to 2016, where we were on the inventory of feeder calves, 2016 versus 2017, there was 1 million more feeder calves available in those fall months in order to be shipped to feedlots or additionally placed in stocker operations. So, again, we're going to be looking at that increase. If we look back to those 2016 numbers, at least 1 million head this fall. So we think about staying in the cash market. Maybe we need to be thinking about some risk management opportunities for those later fall months. Right now there's a premium for those fall months on the future. So, right now there's an opportunity for us to look at that. Again, 1 million more head feeder calves available 2017 or 2018 versus that fall 2016 market. So we know on the supply side we're producing more. This will be our largest beef production year here in 2018, and we're going to be looking for further increases once we get into 2019. So in the commodity cycle, as we're producing the most ever, we've got to understand that, and expect that unless demand significantly increases both domestically and in our export markets, it's going to be some lower prices headed our way. Another factor that we're really got focused on this past month is if you've noticed the drought monitor, the severe drought. We're in D3 and D4, exceptional and extreme drought in the Southern Plains right now. I have some good friends in Oklahoma, and right now, through a lot of their extension planning meetings, they're having emergency planning for, where are we culling at, where are we go ahead and shipping a lot of these feeder calves if those fall or winter calving feeder calves, they're going to be leaving soon if this drought continues to exist. Another thought back to this is we talk about maybe those feeder calf prices rising in the years ahead. What caused those 2014, 2015 high prices? One of those major factors was the drought that existed in the Southern Plains. So, we've got some correlation there, and that this may be one of the causes that obviously maybe it ends U.S. herd expansion, or it potentially could cause further increases from a larger contraction in U.S. cattle inventory numbers. So this emergency planning, it's going ahead and it's taking place in Oklahoma and parts of the Panhandle there in Texas, and how is that really going to impact us? And I think it could have a large impact if this drought continues to persist. Again, parts of the Southeast and here in South Florida, we're abnormally dry. Georgia and Alabama are starting to experience some moderate or severe drought as well. So we've looked at the supply side of things. We've talked about some of the weather concerns. One of the big key factors in 2017, really holding those prices higher, were domestic demand, and specifically export demand. How much additional product we were able to export, because we're producing so much significantly more. We've really got to get into those additional markets. Now, one of the major concerns is we're producing so much more beef, pork, and poultry. What's that going to do to these beef prices in terms of what's at the meat counter? And so what we're looking for, USDA all fresh retail beef prices, and I'd be glad to share this slide with you or speak with you at my booth about it, is we're looking for 2018 prices starting about the third or fourth week of June to significantly decline, much larger than we've seen in years past. We're talking about a decline in terms of domestic demand prices that are going to be similar to 2016. Domestic 2018 beef retail prices falling significantly lower than where we were in 2016. So about 20 to 25 cents lower on our domestic beef retail prices in 2018 versus 2016. Now, you look at the last half of 2016, where so far we've seen our cycle lows. Fats were at 100, feeder cattle were at 120. Could potentially, unless this export market really picks up, we could meet those levels or break through those levels and see new lows. And that's what's kind of projected in that cattle price cycle to happen, unless we can really get a significant increase in demand. But again, that economic cycle, after that law of diminishing returns there, that's expected to weigh heavily on this market. If we just talk about what's available to us today, if we start talking about feeder cattle futures or the feeder calves that we're selling here in South Florida, if we look at where we were 13 months ago, you look at or 11 months ago, May 2017, we look at May 3rd, that was our high in terms of our feeder cattle futures versus where we were yesterday. At the end of yesterday, we were $28 a hundredweight down from where we peaked in May 2017. So that's about $14,000 a truckload loss in revenue for every truckload that we're shipping. So, 2 truckloads, you're looking at close to $30,000 there. That's a significant impact to our bottom line. If you just look at that price change that we had to realize here in March of 2018, we lost $12 a hundredweight to that futures market. And a lot of variables are impacting that. The wall of cattle that we have out there in the feedlots right now is definitely weighing heavily on these feeder cattle futures. So again, if we look at it in terms of what our basic projections are for marketing feeder calves here in Florida during the summer months, for 550-pound feeder calves, this is blending 6-weight steers and 5-weight heifers together. Our projected cash price is around $142 right now using the futures and a South Florida basis of +2. If you're looking at our break even, we're at about the 130 level is what our projected break even over our total cost of production is. Our projected price objective of 157 there, and multiple times during the year we've reached and exceeded that price objective. Our projected profit per head is in that $70 to $80 range right now per feeder calf that we're marketing. And then just in terms of returns over variable costs, that's up there at $220 a head. So that's where we currently are in terms of these feeder calf prices. And the last thing that I'd like to leave you with is talking about some risk management opportunities that we have available to us. And I think in terms of the risk management right now, one of the major opportunities that we have is if we've went ahead and we hedged early, maybe we were planning to market some calves in May or August, we have the potential to increase our expected cash price by re-hedging. Okay, so whenever a deferred contract, a contract later than what we've currently have hedged is a higher price, we can re-hedge our hedge and move out of that May or August contract to a later contract month. So the opportunity now, if you're looking, a move from May to August, you're being able to increase your expected cash price by $5 a hundredweight. On some really big cattle, that's $40 a head there, just by taking advantage of the opportunities that's really presenting itself to us today. If you're looking at May to September, that's $7 a hundredweight. So that's a great move that we can make if we don't want to stay in the cash market and we want to go ahead and protect our price. If we feel like there's some additional benefit out there, I definitely encourage you to take that into consideration. And then the second thing we can do, if we've already used risk management, say we've already have our feeder calves hedged, we can buy that contract back and use some of that additional money in our margin account from our hedging to buy a put option at the money, and that would provide us some additional protection while also allowing if cash prices increase to realize that additional profit. So that's kind of what I'm seeing here on the risk management side right now. I'll be doing some additional extension activities with risk management. If you're interested, I'd be glad to meet with you and discuss those with you. So I appreciate your time. If you have any additional concerns and questions, then I'd be glad to answer those for you. Thank you.